Hello and welcome to our business and portfolio update. And this month, we start with incredibly exciting news, and that's celebrating the recent passing of yet another significant milestone for the Trobe Financial. From our humble beginnings 72 years ago, we now manage over $20 billion in assets across institutional, wholesale, and retail investors. We now have over 130,000 customers across our business, and to each of our wonderful customers, we exist for a single reason: serving you with simple, easy to understand financial solutions which in some meaningful way contribute towards your wealth creation journey. For our Trobe Australian Credit Fund and US Private Credit Fund investors, all 100,000 of you, thank you for placing your trust in us to manage your hard-earned wealth. Back to matters closer to home, and earlier this month, we witnessed a critical shutdown of global IT infrastructure. The catalyst: a single IT service within much of the globe's IT infrastructure, which caused the world to grind to a halt. People were stuck in airports, shopping centres unable to process transactions, healthcare services were unable to treat patients, and a whole range of other flow-on effects took time, money, and a lot of frustration to overcome. Thankfully, the world is largely back to normal. However, there are a range of lessons to be drawn from this shutdown, which can be applied to principles very close to our own hearts here at the Trobe Financial, and that's managing your investment portfolios. Let's start with the simplest of aspects: diversification and knowing what's under the hood. Again and again, we have preached the importance of diversification in investing, not putting all of your eggs in the one basket. Another way to think about diversification is by not committing yourself to a single point of dependency for any part of your investments or indeed your business. In business, there is key person risk. In investing, there is concentration risk. This IT outage saw a whole range of global systems stutter due to a reliance on a single service provider. History shows, certainly from an investment perspective, that the larger the scale of the dependency, the more amplified the outcomes, including, of course, in the event something goes wrong. Consider your own investments. Are you overexposed to a particular asset or asset class? Or indeed, are you overexposed to a particular sector, meaning that your wealth might be overly aligned to the performance of one particular sector or industry? And crucially, do you really know what you're investing in, what the underlying assets are, and where the key risks within those portfolios lie? What drives their performance and outcomes? Holding your investments across a range of assets and sectors puts you in a much better position for success. And so does only investing into assets when you understand what's really under the hood. At the Trobe Financial, our portfolio accounts have always maintained a key focus on diversification and transparency. We hold very granular asset profiles, diversified by borrower, location, and sector, to give the best possible resilience against the movement of one particular sector driving performance. Consider our 12-month term account with a weighting of 54% to residential assets. The balance of assets comprise targeted or strategic holdings across commercial, industrial, construction, vacant land, rural, and cash assets. Each can contribute to the yield profile of the strategy, but none hold an overweight position to adversely impact overall portfolio performance. And we put our money where our mouth is. Each month, we publish detailed information onto our website for the world at large to access, with hundreds of data points so any interested investor can get right down into the nitty-gritty to understand exactly how our portfolios are comprised. And we encourage investors to really get under the hood of the Trobe Financial, as ultimately it is what is under the hood which has delivered impeccable performance for our investors. The 12-month term account, it sits amongst the most diversified strategies in the Australian real estate private credit sector. We'd say we're the most diversified, but no other manager in our space that we can find actually publishes the depth of data we do on a regular basis to allow any meaningful comparison. Looking forward, that often involves looking back, and there is nothing new under the sun. History has a litany of instances where concentrated sectors have come unstuck, with positive and negative outcomes felt for years to come. Consider the GFC, which at its most macro sense had a range of institutions which had grown too big and overly concentrated to a single asset class. The outcome, after the initial shocks, were smaller banks with high capital provisioning and regulators working to disentangle and de-risk complex global financial networks. But what does that mean for us over 15 years on? Well, plenty. In a recent webinar, you'll have heard us talking about key macro drivers of investment into the next generation. One of these was debanking and the rise of private credit. Yes, an outcome of the GFC is banks being forced to focus on remaining smaller, better capitalized, and limiting concentration across the types of loans they will offer. With banks stepping out of a sector, non-banks have stepped in, writing loans to high-quality borrowers who once upon a time would have been serviced by a bank, but for whom the private market now provides a more timely, nimble, and appropriate funding source. In America, private credit has slowly picked up momentum, long supported by institutional and wholesale investors. It has now reached critical mass, sufficient for managers to build diversified portfolios of high-quality assets to suit a range of risk and return profiles, including now for retail investors. Indeed, Trobe Financial has recognized this tailwind, delivering a strategy in US private lending with the launch of our Trobe US Private Credit Fund. This strategy considered the debanking tailwind encouraged by the regulatory response to the GFC, and it delivers a diversified portfolio of directly originated loans made to companies in the US middle market, operating in non-cyclical industries to deliver a premium risk-adjusted and stable income. And we have developed this product with the highest quality counterpart, Morgan Stanley, and its global leading US private credit team. For retail investors, the Trobe US Private Credit Fund offers a return target of 8.5% per annum with monthly income and quarterly withdrawal windows. And of course, our friendly asset management team can be contacted on 1-800-818-818 if you'd like to learn more. History doesn't repeat itself, but it often rhymes, as Mark Twain once wrote. The recent IT outage, it teaches another lesson we can apply here. Stay diversified. Ensure you know how an investment works. Ensure you know what is under the hood, and ensure you understand where the risks are. Thank you for watching.